just record this. Sorry about that. Okay, now today's session is mostly focused on the swing trading side of things. Okay, and the second session, the swing trading part, the actual practical part of swing trading, will be just a follow-on to what we're going to be doing here in the first part, the first session. Okay, so now I'll just take you through the concepts, and there's some other stuff that I'll only be able to cover next week because there's a lot of info and a lot of information that I don't want to get diluted by simply just throwing it in there. So I'll show you guys some new concepts next week for swing trading especially, but for now we'll just focus on these very simple parts of the swing trading. Okay. Now, firstly, you must remember that risk control is your ultimate key to success. Now, it's the only thing that you ultimately do control in the market. Okay. Aside from that, you don't control anything in the market. Okay. You don't control whether the market goes up, goes down, goes sideways, bounces around for 3 to 5 days. You don't control any of that. What you do control is how much you risk and how much you potentially grab every single time that you are right in a particular market. Okay, so those are the only two sets of things that you do have control over. All right, just give me a sec, guys. I just need to switch my network. Okay, this one's giving me a bit of hassle. Let's try and switch to something faster. Okay, there we go. We should be all right now. Everyone should be able to hear me clearly. Okay, type Y there as well if you can hear me. If the sound is okay. All right, awesome stuff. Okay, perfect. Now, as I was saying then, the only thing that you ultimately do control in your trading is your risk control. Okay, that's one thing that you do have control over, and that's the ultimate key to overall success trading. Okay, now understanding that there is market manipulation really means nothing. Okay, now understanding that there's market makers and they spike, they hit your stops, and they do this and they do that means nothing, because you can know all of this stuff, you can know all of these concepts and still not be able to extract pips from the market each and every day or each and every week, simply by trying too hard, in a sense, to sort of fight against what these guys are doing and trying to get caught up in market maker this, market maker that, instead of following your own game plan. You know, if you're looking for M's and W's, obviously you will see them every single place you look, you're going to see an M. Every single place you do look, you're going to see a W formation. Okay, now do not let that be your whole entire scope of doing things, especially if you have been trading in that way and you feel like, okay, this is a bit too intense for me, because trading on a 15-minute time frame obviously is a bit intense for other people. Some people have a longer term bias and they're much more patient with their trades, and of course something a bit more higher time frame would suit them better. Okay, so that's why I say, once you understand the whole concept, okay, the market makers, they're there, the liquidity pools, them triggering the buys and stop orders, and then the shifting away, where that really comes from. Then once you understand those concepts, then you can definitely deviate from the main method of trading and branch into other methods of trading that will actually suit your style, personality, and all of that stuff. Okay, now as I was saying then, take time to observe the markets, especially when they're closed. Okay, if you don't take time to do this, you're not going to get far in trading. You definitely need to look at the markets when they're closed. Saturday, be it Sunday, Friday evening, or anytime when the markets are closed, you need to take time to actually observe the markets. And when you're level-headed and you don't have any money on the line, then you look at the previous week's setups and you look at the next week's predictions or anticipation that you hopefully will come into fruition. Okay, Now that's the main thing that you guys should be doing right now, observing the markets, doing research, and of course just staying in line with every single thing that does go on within the currency pairs that you actually do trade. Okay. All right. Let me remove this. All right, now levels. A lot of people ask about these levels. Am I seeing them right? And these are the most common questions. Okay, how effective is the actual counting of levels? And what's the best way to actually look at levels? Okay, now there is no best way to look at levels. People interpret things in a different way. Okay, we might look at the same chart and we might come up with two different outcomes. That's why I'm saying trading style will obviously be in line with the kind of person that you are. If you're a patient person and you can wait and you're not in a rush and you're very analytical, detail, attention to detail, obviously you don't mind actually waiting for setup. But if you're a bit more aggressive and sort of like ADD, you can't wait for a setup to form properly, you jump in too early. Obviously, you trying to trade long term won't really be something that's going to be effective for you. Initially, when you do it, it will take a whole lot more practice as opposed to someone who has a much more calmer and more patient sort of personality to them. So the levels, no one will see the same levels. It's basically something that you develop as you look at the charts and you do your markets. Okay. If you cannot see the levels within a particular market, then you don't essentially need to trade. Okay, that's one thing that the market can't force you to do, and that is essentially to take a trade. The market won't take trades for you and tell you to manage them. If you can't see a trade or you can't see the levels, it's not clear, it's not black, it's not white, then you essentially shouldn't be in that particular market. Okay, now also what should I do if I get my stocks get triggered and level becomes invalidated? Okay, let's say you counted your level 1, 2, 3 level drop and you saw a nice W formation. Okay, and you went long right over there. You expected the market to continue on already, but it extended lower. Okay, now firstly, what you need to understand, the market doesn't have to respect these levels. Like I always say, the market has no floor, the market has no ceiling. Okay, but as a general rule, in most cases, you will see some sort of structure, and I will describe that structure to you guys later on during the webinar. But what you should be looking at is trying to firstly trade in line with overall trend. You guys know me, most of the time I don't trade. I'd say 90% of the time I don't take a reversal trade unless it's a really good setup. It's a high probability setup. Everything lines up, divergence at an extreme level, near trap volume area. Those are the only types of reversal I will actually take. Okay, and it has to be on a higher time frame. I won't take a W formation, a multi-cycle W formation on a 15-minute or 5-minute time frame. It needs to be something solid and with some I don't know how to call it, but it needs to be very, 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 very clear for me when I actually take it. So when a trade closes below your initial entry, okay, your buy order, or your, let's say in this example, your buy order when the W formed and the market extended down to the low and it closed below the level that you had marked off. So you anticipated a W here, but the market extended. Now, question becomes, do you jump back in or do you just let the trade roll on down without you, or roll on up rather without you? Now, there's one or two ways in which you can do this, guys. I know some of you guys are struggling with stop losses being triggered. You're you're going in the right direction. What I can say is, if you're using a 25 pip or 20 pip stop, it's getting hit. Use a 50 pip stop rather. Okay, so aggregate your risk to a 50 pip stop And then as you become more proficient, obviously then you can just move it down further. But for me, I really don't care where the stop is. Yeah, that's one thing I don't. If you guys saw the Aussie dollar trade that I took on Friday, the stop was mammoth. I think it was 50 pips or something, if it wasn't 60 pips. So for me, in terms of the stop, I don't really care where the stop is. If I do know that I'm going to get 500, 400 pips on a move, a 60, 70 pip stop really doesn't hurt me. Okay, so that's more attuned to the swing trading, guys. But as someone who looks to scalp and take those 50 pips, obviously risk reward needs to be there. But if you're getting stopped out and the market goes in your direction, obviously your equity curve will be down. So rather you take a 50 pip TP, 50 pip SL, and basically trade off that. And the more proficient you become, you just move your stop loss to be a little bit tighter. Okay. Now, if a trade is invalidated, obviously you wait for the next strike zone. Okay, so if the market consolidated and you went along on the W and closed below, and you need to actually see some sort of confirmation, whether it be one spike candle to the downside, you see some divergence on the RSI or the TDI at the extreme levels, or you see a W formation with the second leg spike right through the first leg, or you see the TDI market baseline is actually winding up while the market seems to be more or less in the same place. So those are just some of the things that you need to look for when the market closes below your entry, and not just jump in and like, okay, they hit your stops and then you jump back in going long because, okay, since they hit my stop, then they definitely need to go now. That really doesn't work that way. They can continue to move to the downside. That's why I say do not trade against a very strong trend. I'll show you guys how to identify a strong trend as well as a weaker trend. So when the market is weakening, you'll see that in the candle formations, as well as you'll see it in some of the indicators that you can use, the RSI as well as the TDI. It shows you weakness in the market and they trap in just higher. The market closes higher, the market closes lower. And on the TDI or the RSI, it actually shows you exactly what the market is doing. Okay. Now the market structure, now it has a distinct pattern which it usually follows, and simply because smart money, as we know them, what they choose to do is, their problem is liquidity. Biggest problem that these big boys have is liquidity, and obviously retail traders provide that liquidity by placing nice tight stops. Stops get triggered, placing pending orders in breakout areas. Stops, those pending orders get triggered, and then these guys have that liquidity. So they essentially take that other side of your trade by hitting your stops. Let's say you bought W formation, right, and you went long. Okay, and now all of a sudden the market comes back down, hits your stop first, and then goes up. So what essentially happened is many traders had orders placed at that level. Okay, so that's what we essentially call a liquidity pool. And once the market drops into that level there, obviously when you buy and your stops get triggered, that simply means you sell. And what they do, they dive into all those sell positions, and buy the market, pushing it up. That's why the aggressive move is up. Okay, then all these market makers start jumping into the market now, trying to take advantage of this liquidity pool or this level where the retail traders stops were hit or triggered, and the pending orders to the downside. Let's say on a sell, you had a pending order to the sell side. When they touch that, obviously they shift direction and they all start aggregating in. So that's essentially what happens there. And now the trend is very important as it gives us an idea of the market direction. Okay, being able to read the market structure will help you see whether the trend is up or down. Okay, as a general rule, we know that the market moves 2 steps forward one step backwards, 2 steps forward, 1 step backward, 2 steps forward. Don't know what happened there. I think someone's using my pen. Okay, so it's 2 steps forward, 1 step backward. So hence we have these types of movements over here. So I'll go into detail about this whole market structure, but the market is essentially made up of up, down, and sideways movements. So which have essentially trap volume areas. All right, we're still on the same page, ladies and gents. Okay, so okay, all right then. Okay, so now the market essentially has what we call swings, which would be a swing high as well as swing low. Okay, now as per our understanding, obviously these are random. These are levels that are predefined and actually triggered on purpose, and hence the way that the market looks. Right now, a swing high is essentially what would look like an A top. So A top and A top, and then a swing low is a V bottom, or a W formation. See, this is a nice W formation, and this is also a W formation, and this is a V bottom. Okay, so these are essentially swing highs and swing lows. Now, as we know, the market doesn't move in one direction, or like drops down to, let's say, 100 pips or 1,000 pips. It's been dropping red candles stacking down altogether. Now the market has pullbacks, and essentially these pullbacks are to firstly scare the guys who are short in this level. Let's say you saw this market here, you were short, or you entered a bit late, you were short, comes in, the market comes and takes you out on that. Guys, I'm not sure who's actually. Okay, let me just check here. What's going on? It seems like someone has my marker. So if you think it's you, just don't move your mouse around. I think that's the best solution. Just don't move your mouse around. Or if there's another, I don't know what to call it, tab open up besides the one with the chat. If there's a second one with mouse, text, draw, and all of that stuff, just close it. Then you should be able to clear everything up, so you don't gain control over the marker. Okay, now the swing highs and swing low level essentially provide a clue to what the market is essentially doing. All right, so if you understand the market structure, it's very easy to trade it then, because like I said, at these levels, let's say you sold here and the market obviously shifts, you're in major profit, you come in, you break even, and then the market comes and taps your break even, and then the market moves in that direction in many cases. Right, now on another scale, someone took this as perhaps a W formation, and the market shifts away from you and you don't have a stop in, right? And it comes back in perhaps minus 10 pips, minus 15, minus 5 pips, and you're like, okay, once it gets to zero, and I will close this trade. What happens is, as soon as it gets to, let's say, minus 5 pips, and you're aiming to close the position, then the market just shifts back away from the retail trader. Okay, that's essentially what happens with this. And of course, there is some liquidity at these levels as well. Okay, so these are support, what are called support levels or resistance levels. So there's liquidity there. People trade those levels. They hope hopefully everyone in here should know what a support and resistance level looks like, and hence the fact that it's the most commonly traded way, or it's the most common method of trading support and resistance. And it's no surprise that when these support and resistance levels are actually penetrated, people start to place pending orders, and they buy and they sell at these particular levels and at the breakouts as well. Right, so this being a swing high, obviously you have your primary move or your big move or your aggressive move, and this is what we call a level there. Okay, this is one huge level to the downside, and the market consolidated for some time here, accumulated more orders and shifted away, hitting this high. Once everyone hopped on the long position, the market then shifted away again to the downside. Okay, so if you notice this is all about trap and move in the opposite direction. Okay, so the market needs to get people on the move to provide the liquidity. Because like I said, the big boys, they see where the levels are. They see, okay, there's money here, there's money here, there's money here, there's money here, there's money here. So if you go through all these levels, we're gonna find that liquidity that we're actually looking for. So if they don't go anywhere and they're just chopping sideways, some people will buy, some people will not. Some people aren't convinced. But as soon as they slide through those levels, that to them is the liquidity that they need. And of course, once that happens, they can offload all of their positions. Now, there's certain ways to hide your stop loss and stuff like that, but I won't really touch on that today, probably in the next couple of weeks. But that's essentially if your broker keeps knocking your stop loss, there's a certain way for you to make it hidden from the institutional buyers, institutional sellers. Okay. All right, guys, we're still on the same page. Still good. All questions? Okay. Right, now, essentially what you should be looking for in a market, you can see this as we know it is the peak formation. So that's the peak high. You can look at the type of candles that actually form this peak. 1, 2, 3 candles to the downside. This is a 4-hour chart, by the way. So 1, 2, 3, that is 12 hours. Okay, so that's an entire day of, well, that's half a day rather, of the market moving in one direction. And you can see some traps over here as well. Push the market up, people going long, and the market shifts away back in the same direction. Okay. Now, there's always that call to counter trade. Everyone loves to counter trade. As soon as you see something like this, people start thinking, okay, this market. Sorry about that. Okay. Sorry about that, guys. Right, so as soon as people start seeing on the hard right edge, let's say the market has been going down for 2 or 3 weeks, then they start saying, okay, now the market has gone too far down. It basically has to reverse back to the upside. Okay, now the interesting thing is, as long as there is or there are people taking the long position, providing the liquidity to the upside, institutional buyers and sellers will actually just keep pushing the market to the downside. Okay, smart money will just keep pushing it to the downside, and as soon as the retail trading public starts saying, okay, now I think we should be going down, because the market seems to be going down and we've been buying all this time, getting our hands, fingers burned. Now it should be going up, and then they just shift the direction, and of course the retail traders caught with their hands in their pockets, and they can't really react to that, and the market just shifts away in the opposite direction. Okay. Now, as I said, these are these consolidation areas. This is contract accumulation. Now, being able to read or understand how these form will obviously then give you an edge in your long-term bias or looking at the market, because this is essentially how these guys form levels. Okay, support and resistance are formed by these over here. Aggressive movements don't form support or resistance levels, but these do over here. Okay, here was a nice support level as well, and over here this trade was really looking good as well. Okay, I did take this one. Okay, I usually don't take peak formation trades, but if you're looking at this pin bar, one huge pin bar facing upwards, that was an invitation to actually go long, even though the overall directional bias of this still looks to be short because the market is making lower highs. So the swing is making a swing low and then swing high, not releasing these traders on the upside, and then swing low, swing high, not releasing the previous traders trapped over here, and another swing low, swing high. These guys aren't released, and these guys aren't released over here as well. Okay, so the market should continue on the move to the downside. Now, trading in line with that particular trend will give you a whole lot more pips. Okay, it will enable you to bank more pips in a stress-free way, as opposed to trying to trade everything up, down, up, down, up, down. So once you form one clear bias trade on the daily time frame or the weekly time frame, if you're positioned weekly or if you are a swing trader, basically going to be looking at D1 below. So if you're looking at that in that sense, then you definitely going to make more pips and bank more pips. But also, if you're more aggressive, you have the time, then obviously you can take those 50 pips as well intraday. All right. So being able to spot the market structure or identify it will essentially give you an edge, a major edge in the market. So you can do that using horizontal lines or just draw trend lines, or you can just, because I usually just put a horizontal line on the market and then put a horizontal line here, and I'd probably put a horizontal line there. So this is all done in a clean chart, and once I have my biases in and I've analyzed the market, then I can throw it down to the smaller time frames and lower time frames. All right, guys, still with me. Sorry, I got out of that. Oops. Everybody's still good. Okay. All right, awesome stuff. Okay, we get rid of this. Okay, now with the market as it is, with these pullbacks, there's certain ways for you to see how aggressive the pullback actually is. Okay, now it's called a Fibonacci retracement tool. Everyone here should know it. And the terminology, okay, if you want to be technical, is a technical analysis that refers to areas of support or resistance. So price stops going low and resistance, price stops going higher. Now, there are three main levels that you can essentially have a look at, and I think you can start with the 38.2, 50, and the 61.8. Now, these have a bit more weight for me because at the 50 and 61.8, that means the market could potentially reverse. Now, if the market is trending higher, market is moving higher, hence, if it might take 2 steps forward, it might take half a step, let's say half a step backwards. So that means if the market rises 100 pips, it might pull back 20 pips and then continue another move. Now that denotes a very aggressive upward trend. Okay. Okay, so that, I don't know where the smell is coming from. Okay, that denotes a very aggressive upward trend. And the deeper the pullbacks on the market, so the deeper these pullbacks become, then essentially the trend is weakening and a potential reversal is coming. Okay, but when the stop hunts or the pullbacks or the trap volume areas are essentially very, very shallow, hitting only the 13.2% and just continuing up, that means the trend is still very fresh and it could go for very, very, very long time, an extended period of time. Okay, so those are the 3 main levels that you can use for now. And once you familiarize yourself with using these 3 levels, then you can touch on the more with the extension, because this is just the Fibonacci retracement, and you can use the extension part of it for you to be able to forecast. That's more Swing Traders Club, and I will be covering that soon. All right, guys. Okay, so you're mainly focusing on those 3 levels. Everything else you just block out. You don't need it on the fit. Okay, now this is the same chart that we were looking at, but now we've just inserted the Fibonacci retracement tool from swing high to swing low. Okay, we can see nice push to the downside, market consolidated, came in, tapped the bottom of this rectangle for the level, and you had nice long second push to the downside, market pulled back in, tapped the low. All right, so tap the low of the range that we actually was created here when the market was consolidating from this time, and then the market held, finally it broke, tapped once, tapped 1, 2, 3, and then the market shifted away. And if you look here, this is with a 100%, so this is if the market retraces 100%, this is where it should end up. And this is only to 50%, so we just touched it by 1 pip, I would assume, and it shifted to the downside again. Okay, now if this is why I usually say, if you are trading swing trade, I'm not talking position, because if you're trading on the much higher time frames, then the best way for you to actually ensure maximum profits is to just trade your trade. Okay, you can make anywhere between 500 to 1,000 pips if you trade it, but if you're always setting a TP of 200 pips, that's all you're going to make 200 pips. Now, if your swing trading is for 2 to 3 days, obviously then you put this in, swing high, swing low, and your target would be just before the 50% Fibonacci. Okay, now you can use that as a take profit target. It's very simple. Plus, it helps you to essentially stay in the trade and maximize at least your profits instead of taking the mandatory 50. If you feel that you've got what looks like the peak formation low or peak formation high, that's where you can hold it and at least tap the 50% fib retracement for you to exit. So if you're that type of person, 3 to 4 day swing, then that's definitely obviously will be for you. All right. Everyone's good. Still good, guys? Everyone, so on the same page. Oh, good. All right, no problem then. So, this is essentially what I had for you guys on for this session. So what I'll do, second session, I'll just recap quickly on the Fib and continue with the slides that I do have, and then we'll just have a look at the live markets, and I'll briefly be looking at the entries as well as the exits and how to essentially manage the trade once you in it on the higher time frame versus swing trade. All right, guys. Okay, so I'll end off this session here. Then 5 minutes we'll be able to start.